While the stock market continues to hit new all-time highs, the data underneath those numbers shows a physical economy that is starting to erode. This chart shows the current global supply state. The world typically consumes about 100 million barrels of oil every day, but right now, between 8 and 13 million of those barrels are missing from the daily supply chain. A 13 million barrel deficit is equivalent to losing half of the entire daily oil consumption of the United States. Over the current conflict, the total volume erased from the market will reach 780 million barrels. Looking at the scale of these storage tanks, it's easier to grasp that volume. 780 million barrels is nearly double the entire capacity of the U.S. Strategic Emergency Reserves. When you compare the missing physical inventory to the soaring market prices, the narrative that the energy sector is stable becomes a mathematical impossibility. There is a common perception that the U.S. is insulated from these global shocks because it has become the world's gas station. The actual import data tells a different story. As this map indicates, the United States brings in approximately 6.3 million barrels of oil every single day. While we export 4.1 million, we remain a net importer, with a daily deficit of 2.2 million barrels. Because the U.S. relies on these daily imports to function, any massive disruption in the fragile global supply chain will have an immediate and severe impact on the domestic economy. If millions of barrels are vanishing from the market, why hasn't the price on your screen reflected that shortage yet? The answer lies in the divergence between paper and physical markets. This chart shows the paper price of oil, the Brent futures, hovering calmly around $100 per barrel. But look at the right side. This is the physical price, what it actually costs to have a real barrel delivered today. That price is already surging past $130. This $35 gap serves as a psychological buffer. By trading vast quantities of paper contracts, the visible market price is kept low, which prevents immediate panic among investors. Financial entities are selling paper promises for oil at $100, effectively managing the price on the screen, while knowing the physical barrels to back those promises aren't being produced. We are watching a market that has become completely detached from the physical reality of supply. Outside of the paper markets, the physical reality is already paralyzing international trade routes. Asia felt the impact first. On April 1st, deliveries essentially stopped, forcing the Philippines to declare a national emergency as fuel prices doubled in 24 hours. The crisis is spreading. African nations are now diluting petrol to stretch their remaining stocks, while Europe is implementing forced limits on energy demand. The United States has been shielded by its position at the very end of the global supply chain, but that delay is reaching its limit. Banking data shows the final crude cargoes reached California on April 8th. As this calendar counts down, the global buffer inventory is projected to hit zero by April 20th. When that buffer is gone, the illusion breaks. The artificial paper price and the physical cost of oil will be forced to collide. Once the physical oil runs out, the buyers who purchased those paper contracts will finally demand their actual delivery. This creates a massive short squeeze. The sellers of those paper promises will have to scramble to buy real oil at the inflated market price just to fulfill their obligations. History shows the impact of these energy shocks. In 1973 and 1990, oil supply drops of just 7% led to the scenes you see here: hours-long lines and strict rationing. This chart compares those crises to today. While previous market crashes were triggered by a 7% drop, we are currently facing a 15 to 20% deficit, yet the stock market has continued to rise. With a deficit nearly triple the 1970s crisis, the current market highs are built on a physical void that cannot be sustained indefinitely. This isn't just a concern for Wall Street. It is the beginning of a major food and debt crisis. Energy and food are inseparable. As natural gas prices spike, the cost of urea fertilizer is rising alongside it, which will drive up global food prices over the next year. Meanwhile, rising bond yields are playing the US and UK in a difficult position. High inflation is making it increasingly difficult for the Federal Reserve to lower interest rates without worsening the crisis. The ultimate reality of the economy is physical. You can manipulate numbers on a screen, but you cannot print physical atoms. When the physical shortage becomes too large to hide, the cost of gasoline, groceries, and baseline inflation will adjust to the real-world price of energy. To protect your portfolio, you have to look at the data the mainstream narrative is ignoring. Subscribe to Brick Money for more market analysis, and let me know in the comments how you're preparing for this supply shock. Stay smart, and I'll see you in the next one.